In 2008, Lehman Brothers had $639 billion in assets. On Monday, they were fine. By Friday, they were gone. The collapse happened so fast that even the executives didn't see it coming until Wednesday. But here is what most people don't know. There were warning signs visible for 18 months before that final week. Clear patterns that have repeated throughout history, from the 1929 crash to the 2008 crisis to collapses that will happen in the future. If you want to understand what these signals mean and how to recognize them before everyone else does, you're in the right place. Let's dive in. Financial collapses don't happen overnight, even though they look that way. They're more like avalanches. The snow accumulates slowly, quietly for months or years. Then one small trigger, sometimes something completely unremarkable, sets off a cascade that buries everything in minutes. The question isn't whether avalanches happen. History proves they do. The question is, can you see the snow building up? Over the past century, we've witnessed dozens of major financial earthquakes. The Great Depression, the 1970s stagflation, the 1987 Black Monday crash, the Asian financial crisis, the dot-com bubble, the 2008 global financial crisis, the 2020 pandemic shock. Each one felt unique at the time. Different triggers, different markets, different countries. But when you study the patterns, something remarkable emerges. The same warning signs appeared before each collapse, and most people missed every single one. I'm going to walk you through 5 hidden warning signs that appear before financial collapses. These aren't conspiracy theories or fringe predictions. These are documented patterns identified by economists, central bankers, and researchers who've spent decades studying financial crises. By the end of this video, you'll know exactly what to watch for. And more importantly, you'll understand why these patterns matter for your financial future, whether the next crisis is next year or 10 years from now. Quick note, this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult with qualified professionals before making any financial decisions. The first warning sign is something called liquidity illusion. Here's what that means in plain English. Imagine you're at a concert. Everything's fine. People are enjoying the show. Then someone yells, "Fire!" Suddenly, everyone rushes for the exits at once. The problem? Those exits were plenty big enough when people were calmly leaving a few at a time. But when everyone rushes together, they create a bottleneck. People get crushed. That's a liquidity crisis. In financial markets, liquidity means the ability to quickly buy or sell assets without dramatically affecting the price. During good times, liquidity feels infinite. You can sell stocks, bonds, real estate, whatever you own, and get cash almost immediately. But that's an illusion. That liquidity exists because everyone isn't selling at once. The moment everyone tries to exit together, liquidity vanishes. This pattern appears in every major financial crisis. During the 1929 crash, stocks that traded smoothly for years suddenly had no buyers at any price. In 1987, portfolio insurance strategies designed to protect investors actually accelerated the crash when everyone tried to sell simultaneously. In 2008, mortgage-backed securities that were traded daily simply couldn't be sold for weeks. According to Bank for International Settlements research, the average time to sell a corporate bond during normal conditions is typically around 15 minutes. During crisis periods, that can jump to hours or even days. Some bonds can't be sold at all. The assets didn't fundamentally change, but the liquidity disappeared. Here's what makes this insidious. You don't see the liquidity problem until it's too late. It's like discovering the fire exits are blocked only after the alarm goes off. In 2007, mortgage-backed securities were traded smoothly every single day. Banks used them as collateral. Rating agencies called them safe. Then in August 2007, the market for these securities simply froze. Not because the underlying mortgages all defaulted overnight, they didn't. Because everyone realized at the same time that if they needed to sell, they might not find a buyer. Modern markets face a new dimension of this old problem. More trading is now algorithmic. When algorithms detect stress, they pull back simultaneously. It's like having 1,000 people all programmed to run for the exit at the first sign of smoke. This amplifies the liquidity illusion. Markets appear deep and liquid until the moment everyone needs liquidity at once. So how do you spot a liquidity illusion before it collapses? Watch for bid-ask spreads widening. That's the difference between the price someone will pay to buy an asset and the price someone demands to sell it. When that gap grows, liquidity is deteriorating. Also, watch for sudden increases in market volatility, especially during low-volume trading periods. That's the market getting nervous. These signals appear before every crisis if you know where to look. The second warning sign is what economists call debt saturation. Think of it like this. When you first get a credit card with a $10,000 limit and you owe $1,000, adding another $1,000 of debt is manageable. Your payments go up, but you can handle it. But when you're already at $9,500, adding another $1,000 isn't just harder, it fundamentally changes your situation. You're now maxed out. One unexpected expense, and you're in crisis. Economies work the same way. Throughout history, debt crises follow a predictable pattern. Debt grows during boom times. Everyone believes growth will continue forever. Then something changes. Growth slows, interest rates rise, asset prices fall, and suddenly, debt that seemed manageable becomes crushing. The Bank for International Settlements identified a pattern after studying dozens of financial crises. When private sector debt grows more than 10 percentage points above trend over a 3-year period, a financial crisis typically follows within 3 years. This pattern appeared before the 2008 crisis, before the 1997 Asian crisis, before Japan's 1990s collapse, and before the Latin American debt crisis of the 1980s. Why does this happen? Because debt creates obligations, interest payments, principal repayments. When debt grows faster than income, eventually you reach a point where servicing existing debt requires taking on new debt. You're borrowing to pay off borrowing. That's not sustainable. And the moment growth slows even slightly, the whole structure becomes unstable. Here's what most people miss. The danger isn't just government debt. In fact, historically, private sector debt, household and corporate, has been a more reliable predictor of financial crises. Before 2008, U.S. household debt reached 98% of GDP. That was unprecedented. People were borrowing against home equity to fund consumption, assuming home prices would rise forever. When prices stopped rising, the debt remained. The crisis followed. The same pattern appeared in Japan in the late 1980s. Corporate and real estate debt soared to record levels. Everyone assumed Japanese asset prices could only go up. When they stopped rising in 1990, Japan entered a deflationary spiral that lasted decades. The pattern repeated in Spain and Ireland before 2008, massive private sector debt booms that ended in systemic crises. Now, this is where it gets really interesting. It's not the absolute level of debt that matters most. It's the rate of acceleration. An economy can handle high debt levels if they're stable and income is growing steadily. But when debt accelerates rapidly relative to income growth, that's when risk spikes. Whether we're talking about the 1920s, the 1980s, the 2000s, or today, the pattern is consistent. The third warning sign is asset price disconnection. This is when asset prices rise far above what underlying fundamentals justify. It's not just that prices are high, it's that the relationship between price and value breaks down completely. Let me give you concrete examples across different eras. In 1637, during the Dutch tulip mania, a single tulip bulb sold for more than 10 times the annual income of a skilled craftsman. In 1929, stocks traded at valuations that assumed eternal profit growth. In 1989, the grounds of the Imperial Palace in Tokyo were valued at more than all the real estate in California. In 2000, technology companies with zero revenue commanded billion-dollar valuations. In 2007, Las Vegas homes doubled in price in 3 years while income stayed flat. Different assets, different centuries, same pattern. Prices disconnecting from any rational measure of value. How do you measure this disconnection? One tool is the CAPE ratio, the cyclically adjusted price-to-earnings ratio developed by economist Robert Shiller. It compares stock prices to average corporate earnings over the past 10 years, adjusted for inflation. The historical average going back to 1880 is about 17. Before the 1929 crash, it reached 30. Before the 2000 crash, it hit 44, the highest level ever recorded. Before the 2008 crisis, it reached 27. Real estate shows similar patterns. You can measure home prices relative to local incomes or relative to rents. Historically, homes cost about 3 to 4 times median household income. When that ratio rises above 6 or 7, you're in bubble territory. This pattern appeared in Japan in 1989, in the US in 2006, in Spain and Ireland before 2008, and in various markets at various times. Here's the nuance most people miss. Asset price disconnection alone doesn't cause a crisis. Plenty of bubbles deflate slowly without triggering broader collapses. The South Sea bubble of 1720 popped, but it didn't destroy the British economy. The dot-com crash wiped out trillions but didn't trigger a banking crisis. The danger comes when those inflated assets are used as collateral for debt. Then when prices fall, it triggers margin calls, forced selling, and cascading defaults. That's what turns a bubble into a crisis. This is exactly what happened in 1929. Stock purchases were heavily leveraged. You could buy stocks with just 10% down, borrowing the rest. When prices fell, margin calls forced more selling, which pushed prices down further, creating a death spiral. The same pattern appeared in 2008. Housing prices were not just high, they were financed with extreme leverage and securitized into complex derivatives. When prices fell, the entire financial system seized up. You might be thinking, can't authorities prevent these patterns? Don't they step in? That brings us to warning sign number 4, policy exhaustion. Every financial crisis is followed by massive policy intervention. After the 1929 crash, the government created deposit insurance and securities regulation. After the 1970s inflation, central banks adopted strict monetary targeting. After the 1987 crash, circuit breakers were installed in markets. After 2008, central banks deployed unprecedented stimulus and regulation. These interventions help stabilize crises. But here's the problem. Each intervention leaves less room for the next one. It's like using antibiotics. They work, but overuse creates resistance and side effects. Consider interest rates. Historically, central banks kept rates around 4 to 6% during normal times. This gave them room to cut rates by several percentage points when crisis hit. After 2008, rates went to zero in many countries, even negative in some. When the pandemic hit in 2020, there was almost no room to cut. Central banks had to invent new tools, buying corporate bonds, directly funding businesses, helicopter money, or consider government debt. In the 1960s, U.S. federal debt was around 35% of GDP. There was enormous fiscal capacity to respond to crises. By 2008, debt had risen to 65% of GDP, but there was still room to borrow. After the 2008 crisis and pandemic response, many developed countries have debt above 100% of GDP. That doesn't mean they can't borrow more. They can. But each crisis pushes debt higher, and high debt eventually constrains future response capacity. According to research by economists Carmen Reinhart and Kenneth Rogoff, who studied 8 centuries of financial crises, governments and central banks faced diminishing returns on intervention over time. The first intervention works well, the second works less well. Eventually, you reach a point where intervention creates as many problems as it solves. Inflation, moral hazard, zombie companies, asset bubbles. This is policy exhaustion. Not that policy is useless, but that authorities have less room to maneuver with each successive crisis. And markets know this. When the next crisis hits, there's uncertainty about whether authorities can or will intervene as aggressively as before. That uncertainty itself can amplify panic. But wait, there's something even more important. The 5th warning sign is fracture in the financial plumbing. This is the least visible but potentially most dangerous pattern. The global financial system runs on infrastructure most people never think about. Overnight lending markets, repurchase agreements, derivative clearinghouses, payment systems, foreign exchange swaps. This plumbing allows money to flow between banks, across borders, and through markets. When it works, it's invisible. When it breaks, everything stops. Every major financial crisis involves some breakdown in this plumbing. In 1907, a panic in the trust company sector froze interbank lending and nearly collapsed the U.S. financial system. In 1974, the failure of a small German bank called Bankhaus Herstatt created chaos in foreign exchange settlements, the Herstatt risk, that regulators still worry about today. In 1998, the collapse of long-term capital management threatened to seize up derivative markets. In 2008, the commercial paper market, where companies get short-term funding, simply froze. What makes plumbing failures so dangerous is their speed and interconnection. A problem in one obscure market can propagate to the entire system in hours. In September 2008, money market funds, considered the safest, most boring investment, broke the buck when the reserve primary fund couldn't maintain its one-share price. This triggered a run on money market funds globally. Within 48 hours, corporations couldn't access basic working capital. The government had to guarantee all money market funds just to stop the panic. Here's the pattern. Financial plumbing breaks first at the joints, the connection points between different parts of the system. These obscure markets don't make headlines until they freeze. Then suddenly, everyone realizes the entire system depended on them. It's like discovering your house foundation is crumbling only when cracks appear in the walls. Modern finance has created new plumbing, clearinghouses for derivatives, high-frequency trading networks, stablecoin ecosystems, cross-border payment systems. Each innovation creates efficiency during normal times, but each also creates a new potential failure point. And these systems are interconnected in ways that even regulators struggle to fully map. The Financial Stability Board has documented how the rise of non-bank financial intermediation, hedge funds, money market funds, insurance companies, has created new stress points in the plumbing. These institutions aren't subject to the same regulations as banks, but they're deeply interconnected with banks and markets. When stress hits, it can propagate through these connections faster than anyone can respond. So what does all this mean for you? How do you think about these patterns? First, understand that financial crises are not black swan events. They're not unpredictable. The patterns repeat because human behavior repeats. Leverage builds during good times. People assume the recent past predicts the future. Risk gets mispriced. Then something triggers a repricing, and the leverage amplifies the fall. This happened in 1929, 1987, 2000, 2008, and it will happen again. Second, recognize that you can't time these things perfectly. Knowing a pattern exists doesn't tell you exactly when it will break. Markets can remain irrational longer than you can remain solvent, as the saying goes. Some of the investors who correctly identified the 2008 housing bubble still lost money because they bet against it too early. Third, focus on resilience over prediction. You don't need to predict the next crisis to prepare for it. Hold some liquid assets, cash or equivalents that you can access quickly without selling at fire sale prices. Avoid excessive leverage. Debt amplifies gains, but also amplifies losses. Diversify across asset types and geographies. Understand what you own and why. These basics have protected investors through every crisis in history. Fourth, watch the patterns we discussed. When you see liquidity deteriorating, debt accelerating faster than income, asset prices disconnecting from fundamentals, policy running out of room, and financial plumbing showing stress, pay attention. Not all of these need to appear at once, but when you see multiple patterns converging, risk is elevated. This is true whether you're analyzing markets today or 10 years from now. Fifth, study history. Every crisis feels unprecedented while it's happening, but they all follow templates from previous crises. The 2008 crisis looked new, but it followed the same pattern as the savings and loan crisis of the 1980s, which followed the same pattern as bank runs in the 1930s. The technology might change, subprime mortgages instead of railroad bonds, but the underlying dynamics don't. Finally, remember that crises create opportunities, not in a callous way, but in a realistic one. Asset prices that became disconnected from value eventually reconnect. That creates chances for patient investors with dry powder and strong fundamentals to build long-term wealth. Warren Buffett's best investments came during crisis periods, buying quality assets at distressed prices. The key is surviving the storm so you can take advantage when it clears. No one can predict exactly when the next financial crisis will hit. The global economy is complex, and there are always factors pushing in different directions. But history shows us that certain patterns appear before instability. Understanding those patterns doesn't make you a prophet. It makes you informed. And in finance, being informed beats being surprised every single time. These 5 warning signs, liquidity illusion, debt saturation, asset price disconnection, policy exhaustion, and financial plumbing fractures, have preceded every major financial crisis of the past century. They'll precede the next one too. Now you know what to watch for. If this changed how you think about financial warning signs, you will want to check out our video on how currencies actually collapse, the specific mechanisms that turn economic problems into monetary disasters. And if you haven't subscribed yet, now's the time. We're just getting started uncovering the truth about global finance. See you in the next one.